Hello, folks. This is Victor Cuevas. Today, I want to share some great information with you that I think is going to give you some great value for your future. So stick with me. You will get a lot out of it. But today, I'm reading out of the Wall Street Journal. I think it's the best newspaper in the world, and I do a lot of reading when it comes to financial things. It's part of who I am, part of what I do, and also I promote that you educate yourself financially as much as possible. You really need to do that, especially the way things are today. But this is out of the business and finance section, and it's from November 23rd. And there are two titles, two articles, one right above, right after the other. And the first one is entitled "Some Bulls Trade Lightly or Tread Lightly into 2014." And it begins by with the stock market strategists, typically a bullish bunch. That means they think the market's going to go up in the future, are taking a cautious approach to 2014. The S&P 500, that's the Standard & Poor's 500 stock index, is heading into the final weeks of 2013 with a 27% gain despite a sluggish global economy, stalling corporate earnings growth, that's important to note, and worries about a pullback by the Federal Reserve in its efforts to support the U.S. economy. I find it interesting that it says a pullback by the Federal Reserve in its efforts to support the U.S. economy. In other words, they're going to pull back on printing money. They're still printing money, not just much. And it goes on to say, but even as many strategists expect an improved backdrop next year and for interest rates to stay low, many are expecting the stock rally to cool significantly. Forecasts center on gains in the mid to high single-digit percentages for the S&P 500 in 2014. In other words, the stock market is up well over 20% this year. It's doing great. But next year they're saying under 10%, single digits. Do we do we believe them or not? Well, further on it says that the average forecast among 9 analysts that have thus far released 2014 outlooks say that the market is in for a 4.1% gain from Friday's close. In other words, for next year, when you take these 9 analysts and more to come, on the average, when you average out their forecast, it comes out to about 4.1% for next year. What a drop from 27 to 29% this year to 4.1% next year. Wow, why would that happen? By way of contrast, for the past 13 years, the average forecast has called for 10% gains a year. So these same guys for the last 13 years have been saying, hey, this year's going to be 10%. This year's going to be 10%. But what's been the truth? Well, it goes on in the article to say since 2000, stocks have returned an average gain of 3.3%, well below the 10% predicted by strategists. Now, folks, these are the quote unquote gurus on Wall Street. Every year they're giving you forecasts of what to expect. And every year they've been telling you 10%. And every year, just about every year, they've been wrong. In fact, the stock market, when you average it out for the last 13 years, 3.3% a year. Wow. It makes you think whether the stock market is really the best place to put your money, doesn't it? Now, I'm not here talking to you today as an investment advisor. That cap is off my head, because my website has nothing to do with the stock market. It has everything to do with getting out of it and creating your own bank. But this information is essential, especially with the next bit of information I'm going to give you that kind of correlates with this. Stick with me because this is good stuff. The title here is Buying Stocks at Record Highs. Will you be sorry? Hedge fund manager Carl Icahn says he is very cautious on U.S. stocks which could easily have a drop from their new record highs. Ben Inker, a director at asset manager GMO, forecast that overall U.S. stocks will suffer losses of 2% annually, counting dividends and inflation through 2020. Now, here are some guys that think that the stock market is actually going to go down every year for the next 6 years. Are you getting a little more confused? Warren Buffett says the U.S. stock market is valued in a zone of reasonableness. In other words, Warren Buffett, the forgot the name that they affectionately call him, the Oracle from Omaha is what they call him, because he's supposed to be able to tell the future, so to speak. He's saying, hey, don't worry about the stocks. They're reasonably priced right now. They're not too expensive. They're not going for a fall. Don't worry about it. Just keep investing. Well, I don't know. It goes on to say, so who is right? I don't even know who's right. In fact, okay, now, this is what everything I've been talking about boils down to. And folks, don't leave the video yet. This is where the rubber hits the road. And this is the main point I'm trying to make. Please listen to this carefully. In fact, whether stocks are overvalued or fairly priced isn't the question that investors should be asking. Instead, what you need to answer is this: how much can I stand to lose before I will bail out? How much can I stand to lose before I will bail out? Folks, do you really want to depend on these guys for your decisions about your financial future, about your nest egg for retirement, when they get it wrong so much of the time, and when the gurus don't agree with each other anyway? And this writer for the Wall Street Journal, and he writes a column, The Intelligent Investor, Jason Zweig, he's saying it doesn't make a difference. The question you need to ask yourself is how much do you want to lose before you get the heck out of the stock market? I don't want to go through my life towards retirement thinking, oh, when should I get out? When should I get in? Well, most people get that wrong. Both the Dow Jones Industrial Average and the S&P 500 set record highs for this week. Counting dividends, U.S. stocks have returned 29% so far this year. Well, here's the interesting thing to note. Why did it shoot up like that? Well, look at this. It says about $23 billion flowed into U.S. stock mutual funds in the 4 weeks that ended November 13th. So between October 13th and November 13th, $23 billion just went rushing into the stock market. Why is that? Well, people have been kind of holding back. Is this market really on the go? Is it? I mean, sometimes it goes up and then it drops, and then I lose my money, and I don't want to get in yet. I'm going to stay safe. And they stay safe for years. And all of a sudden, the market is on a tear, and they go rushing in at the end of it. And in that same sentence, it goes, you have the $23 billion going in the 4 weeks, and it says, and that's after more than $37 billion flowed out over the previous 12 months. So for 12 months, money has been drained out of the stock market. And now all of a sudden, the last 4 weeks, it goes rushing back in. That's craziness. That's people trying to figure out what's it going to do. Well, a lot of people say, well, I've got the answer to that. I'm just going to put money in gold. and you hear commercial. I mean, I'm getting tired of the commercials about gold, aren't you? Uh, they're on TV all the time. Well, look at this paragraph. The only significant asset that has lost value this year, you guessed it, gold, has fallen 25% since December 31st. Now, how would you like to have your portfolio of whatever it's in go down 25% in 11 months? Would that be about the time to get out? And that's gold. Has that happened in the past? Well, guess what? Gold fell 62% between February 1980 and September 1999. That's a 19-year period. In the 80s and 90s, when gold lost its value to the tune of 62%. Why? The stock market was on a tear. The stock market has been on a tear this year, and gold has dropped like a rock. Folks, are you getting the message? Are you getting kind of the idea I'm trying to get across to you? It the financial world can be a very, very confusing place to play in. And I'm saying don't play in it. I'm not telling you don't put money in, invest in the stock market. What I'm saying is this, and hear me very clearly on this. And this is something that I've learned more and more over the last few years, especially since 2008. A huge portion of your money for the future, and you decide what that percentage is going to be, 20, 30, 50, maybe more, depends on you and your family and what your dreams and desires of the future for the future are. But I'm telling you this, whatever they are, a great portion of your future, financial future, should be somewhere where it's never going to lose money, somewhere outside of the market where you can make money year after year after year and you don't have to worry about it. So that when you read articles like this, or you hear someone like me tell you about them, instead of going, oh my goodness, my whole, just about all my futures in my 401k or my IRAs or whatever, and they're at risk, and I don't know what's going to happen. Well, if you have your money someplace away from there that you don't have to worry about what happens in the market because your money isn't in the market, and it continues to grow for you year after year after year, guaranteed, then you can read these articles and say, well, I'm not worried about it. Well, I've got some money over here in the market. I need to learn from this and kind of look at it more closely, be more involved. But in the grand scheme of things, guess what? The main part of my nest egg is right here, and I know it's going to be there for me in the future, and I'm going to be able to draw an income for the rest of my life no matter what. That's where you need to be, or at least a portion of your money. And folks, right here at this website, we talk about creating your own family bank. And your own family bank is the depository for that part of your nest egg. It is one of the best options available out there where you can put your money where it's going to continue to grow year after year after, and it's compounding interest. We're talking about saving money as opposed to investing money. Do you get the difference there? There's a very clear difference. When you save money, it grows guaranteed on compounding interest. That means you have your money here, it grows a certain amount. At the end of the year, you have this. The next year begins to grow and it goes on top of that. When you have money invested, it just goes up and down in value. So there's no compounding there. You just hope that at the end, it's gone up more in value than gone down in value. But when you save and you save the right way, the money is just going to continue to go up every year because it's earning interest on a compounding manner. So you need to have a major portion of your money there, and that's what the family bank is all about. And so your family bank helps you get out of debt, which is the next main thing you got to do is you have to get yourselves out of debt, folks. Don't go into the uncertainty of the financial future that's that this country is looking at up to here in debt. You can't do that, folks. Get yourself out of debt. Your family bank will help you do that. And then in the future, you're going to have to borrow money. There's hardly any way that the average family, whether you make 30 or 40 or $50,000 a year, whether you're making $250,000 a year, to go your whole life and never borrow money, it's almost impossible. So if you're going to borrow money, have your own bank established. Borrow money from your bank and pay it back with interest. When you do, guess what? It creates more wealth. More wealth in that place that I'm talking about that continues to grow, continues to earn interest, compounding year after year. So that when you get into the retirement someday and you've spent your life borrowing money for cars, vacations, furniture, um, weddings, college, establishing a business, buying real estate, all those reasons why you might want to borrow money. You can borrow much of it from your own family bank. That all creates even more wealth for you. And now you're in retirement and you get to draw money from your bank on a tax-free basis for the rest of your life. Anything extra that you want to do something different with, then you want to be in the stock market, have at it. Educate yourself. Take a course. The more you know, the less risky the stock market is. But have your core right here in your family bank. Money that you can actually use to live life by, to be able to borrow money to provide for your family's future financing needs, and at the same time create wealth. Folks, we're talking common sense and prudent and prudent action on your part. And that's why I've established this whole website to show you how this can work and to uh, help you see and realize if this really is the best way for you to go. So to wrap it up, folks, don't don't put yourself in a position where when you read these kinds of articles that you start rubbing your hands together and worrying about the future. Separate yourself from that mess. Establish that rock solid foundation with your own family bank and put yourself on the path to financial prosperity. Because folks, I want you to own your future, not rent it. Own it. This is Victor Cuevas. Live debt free and retire tax free. I love you folks and hope to talk to you soon.